Denison Mines, ticker DNN, is absolutely surging in live trading. As of 12:34 p.m. Eastern Time on October 28, 2025, the stock is trading at $3.115 per share. That is a massive move, up over 12% on the day, or 33.5 cents, on truly explosive volume that has already crossed 73 million shares. This isn't a quiet drift up. This is an aggressive, high-conviction move that is pushing the stock right up against its 52-week high of $3.42. The market is clearly reacting to something significant, and many watching this move are likely making a critical mistake. The immediate assumption, the broad market expectation, is that this is just another uranium stock riding the wave of a soaring spot price. With uranium topping $83 per pound and a well-documented structural supply deficit where demand is far outstripping production, the consensus view is that a rising tide is lifting all boats. Investors piling into the sector on platforms like Robinhood or SoFi Invest, who have been watching high flyers like Nvidia stock or Tesla stock, see a hot commodity and are looking for pure play exposure. Denison, being a popular name, fits that bill perfectly. But that expectation, while logical, misses the entire story. The reality of what is happening with Denison is far more specific and infinitely more powerful. Today's 12% surge isn't just about the price of yellow cake, it's about the fundamental de-risking of one of the most valuable, undeveloped uranium assets in the world. What the market is finally digesting is the monumental progress at Denison's 95% owned flagship Wheeler River project in Saskatchewan's Athabasca Basin. This isn't just another patch of dirt, it's home to the Phoenix and Griffin deposits. The real story here, the one that institutional desks using interactive brokers or portfolio managers at Fidelity are laser-focused on, is technology and permitting. Denison is pioneering the use of In-Situ Recovery, or ISR, mining for its Phoenix deposit. This is a method that has never been used in this high-grade region before. It's a high-tech, lower-cost extraction method that essentially dissolves the uranium underground and pumps it to the surface, avoiding the need for massive, expensive traditional open-pit or underground shafts. The risk has always been twofold. One, would the technology work as planned? And two, would the Canadian regulators, known for their stringent standards, ever approve it? For years, this risk has kept a lid on the stock. The market expected a long, expensive, and uncertain development path. The reality that has been unfolding this year has completely shattered that expectation. In July of 2025, Denison announced it had received Provincial Environmental Assessment approval. This was the first and arguably one of the most difficult regulatory dominoes to fall. It was a massive validation of their science and their environmental planning. But the final hurdle remained: federal approval. And that is what is happening right now. The Canadian Nuclear Safety Commission, the CNSC, has public hearings scheduled for this very quarter, starting in October and running into December, to review the federal environmental assessment and the application for a license to construct. Today's explosive volume and price action strongly suggests the market is front-running a positive outcome. The risk that has defined this stock for a decade is evaporating, and the price is snapping violently higher to reflect a new, de-risked reality. Let's look at the trading action itself. A 12% move on over 73 million shares is not retail investors idly buying a few shares through the Robinhood app. This is significant capital rotating into the name. This is institutional buying. We're also seeing the stock price smash directly into the average analyst price target, which sits right around $3.15. When a stock hits a consensus price target with this much force, it almost always signals that the analysts are behind the curve and a wave of upgrades is likely imminent. The old models were based on a high-risk speculative asset. The new models must account for a project that is on the final step to being fully permitted. The 2023 feasibility study for Phoenix already laid out the staggering potential: an after-tax net present value of $1.56 billion with a jaw-dropping internal rate of return of 90%. Those numbers were based on the assumption of success. The price action we see today is the market moving from assuming success to believing in it. This is the difference between self-investing in a lottery ticket and making a calculated online investment in a project that is crossing the finish line. The company has already completed roughly 80% of the detailed engineering for the Phoenix plant. They aren't waiting, they are preparing to build. This momentum is what separates Denison from many of its peers. While other explorers are still drilling and hoping, Denison is in the final stages of regulatory approval for a fully engineered, world-class, low-cost mine. For those less familiar with the company itself, Denison Mines is not a new kid on the block. It's a Canadian-based uranium exploration and development company. Its entire focus is the Athabasca Basin in northern Saskatchewan, which is basically the Saudi Arabia of uranium. It hosts the highest-grade deposits on the planet. The company's business model is to find, de-risk, and develop these assets. Their crown jewel is Wheeler River. While the Phoenix deposit is the ISR technology play, the nearby Griffin deposit is a more conventional underground mine, giving the project a powerful 1-2 punch. In the past, the stock has been incredibly volatile, a proxy for the boom and bust cycles of the uranium price. But this time is different. The company has methodically executed on a multi-year plan to prove the technical and economic viability of ISR at Phoenix. They completed feasibility field tests, they completed the full feasibility study, and now they are navigating the final regulatory gauntlet. This shift from a speculative explorer to a near-term developer is the core of the current re-rating. While many investors are still chasing Apple stock for consumer electronics or looking for the next AI play, the smart capital is flowing into the hard assets and critical minerals needed to power that technology, and uranium is at the top of that list. Fidelity mutual funds and various clean energy ETFs have been increasing their exposure to the nuclear fuel cycle, and Denison is a primary beneficiary of this thematic shift. This all hinges on those CNSC hearings. Comment below, do you think Denison gets the final federal approval before the end of this year, or will it be delayed into 2026? Let me know your thoughts on the timeline. Looking forward, the future outlook is now defined by a few key catalysts. The expectation was that the timeline to production, slated for around 2027, was ambitious. The reality that with the provincial approval in hand and the federal process at its conclusion, that timeline looks increasingly solid. The primary risk, of course, is a negative surprise from the CNSC. Any unexpected delay or request for more information could pull the stock back sharply. That is the risk you take when a stock has run this hot into a binary event. However, the opportunity is immense. If, or perhaps when, that final federal approval is granted, Denison will be one of the only companies in the world with a fully permitted, low-cost, high-grade uranium project ready for a final investment decision. In a market screaming for new supply, this would make Denison arguably one of the most attractive assets in the entire energy sector, not just for investment through an individual brokerage account, but as a potential acquisition target for one of the senior producers like Cameco. The gap between expectation and reality is closing fast. The market expected a high-risk developer perpetually years away from production. The reality emerging is a de-risked Tier 1 producer in waiting about to be handed the keys to one of the most economic uranium mines on Earth. The 12% jump you're seeing today isn't the end of the move, it's the price of that new reality setting in. Disclaimer: this content is for informational purposes only. It's not financial